know yours is SAMBUINFOREX, Sambuin Forex. Welcome again to my YouTube channel. In this today's video, I'm going to be teaching you, or I'm going to be documenting the forms and types of forex trading. Basically, there are two main forms of forex trading, and there are about four types of forex trading. So the two main forms of forex trading. Before we continue, before we do or continue, we do upload weekly videos. So if you are new to my new channel, you have 5 seconds to hit the subscribe button. So let's go 1, 2, 3, 4, 5. All right, so let's move on. So basically, the two main forms of forex trading are either the first being trending and the second being contrarian. So trending means you are trending in the direction of the overall market. I hope you understand. So through trending, you look for the overall direction of the market using higher time frames, and you come with a lower time frame, and you look for trading opportunities in the direction of the overall market. For instance, if the market is uptrend, if the overall direction is uptrend, you come a lower time frame and for trading opportunities in direction of that is being uptrend. And if the market direction overall direction is downtrend, a higher time frame, you look for trading opportunities, a lower time frame for downtrend opportunities. So that is trending. So contrarian is like it's also called contra trending. So it means that you're trading against the direction of the overall market. You understand? For instance, if the market, if the overall direction of the market is downtrend, you come and look for trading opportunities against the overall direction. For instance, if the market is uptrend, you come and look for trading opportunities uptrend, and if the market is downtrend, you come and look for trading opportunities downtrend. So you are going against the direction of the overall market. So generally, the first principle of forex trading is that when you're trading forex trading, you have before I will say what I'm to say. Basically, the main advantage of trending over contrarian is that trending has is the market direction moving 70% in the overall direction, and the market can move about 30% against the overall direction. So you understand that with trending, you have 70% of the overall direction market, and with contrarian, you have just 30% of the overall direction of the market or moving trend. So generally, it's good to trade in the direction of the overall market, since the market will moving 70. Because if you are going against the direction, it means that the trend will move, the market may moving against the trend just about 30%. And again, added to this, if you are trading against the direction, you are going to be using high risks, and you will not stay in the market for long, because at any moment of time, the direction is going to reverse again in the direction of the overall market. So always stay lesser in the direction against the overall direction, and you can stay longer in the direction of the overall market. My advice to you is that if you are new to forex trading, always trade in the direction of the overall market using higher time frame and looking trading opportunities in lower time frame. That is trending. Always stick to trending. Contrarians or contra trading are meant for pro forex trading, because if they go into, they look for sniping increase. As soon as they're done, that is it. They don't waste time, don't stay long by the market. So that were the two forms of forex trading. So let me share to you the four main types of forex trading. The first, we have we have swing low, swing high, we have day trading, and we have position trading. Next four, those are the four main types of forex trading. So the first aspect of being scalping, the type of forex trading where you enter the market several times using smaller time frame, like the 5 minute time frames and the 1 minute time frame. You use the 1 minute time frame, and you look for 1 minute time frame, and you look for the 5 minute time frame, and you look for trading opportunities. And generally, the most important aspect I would advise you is that when you are doing escaping, always trade in the direction of the overall market. That is, always follow the overall trend. That is, you do trending using escaping. So, for instance, you trade, since you are in the direction of the overall market, you look for trading opportunities. For instance, when the market is going bearish, when it's about to go bullish, you can enter a trade. When the bullish trade is being done, you can take off your profit, and you come back again and you re-enter the market when trading opportunities come. So you understand that you enter the market several times, several times. And for scalping, it's very risky, because the moment you want to do scalping and you are not there to monitor your trade can easily go against you. So scalping is a very important trading strategy and trading skill, which is very profitable, but you have to be online to monitor your trade. You have to be online. You have to be there to monitor your trade, or if you're not there, therefore you have to set small stop loss and very small take profit interval. That is, the risk reward ratio must be very close. How you understand? If you not be online, and if even you are going to be online, you still have to set this risk reward ratio, because without the risk reward ratio, you can blow all your account. How you understand? So that was the case of scalping using smaller time frame. That is mainly the 1 minute time frame and the 5 minute time frame. Yeah, some other people go as far using the 15-minute time frame and 30-minute time frame. But for scalping strategy, scalping the most important goes with the 5 minute time frame and the 1 minute time frame. I hope you understand. You enter the market several times. You enter, you take your profit, you enter, you take your profit, and you enter, you enter again. I hope you understand. If you have problems on how to enter the market, check my previous video on how I caption when to buy and when to sell. You are going to have some basic criteria and principles when it comes to trading forex. So the second type of forex trading I will be talking here is swing low, swing high. Swing low, swing high. Yeah, it's very simple strategy, though at times difficult, and it's based on mainly on the 1 hour time frame and the 4 hour time frame. Here, what you do is that you picture a very you play with higher time frame, like 1 hour and 4 hours. And I will advise to always trade in the direction of the overall market. So when you have already observed the direction of the overall market, what you do is that you can come and observe the market. You look for a very particular, for instance, if the market in a 4 hour time frame or 1 hour time frame, when the market has been overbought, if the market has been overbought, you can capture a trade at a particular time. Then you picture from that 4 hour time frame or 1 hour time frame, and you picture a very large interval of pips. Hope you understand. When it's going to oversold, they are going to make profit. Swing, that is, since it was overbought and you are expecting that it's going to oversold, that means you are coming from swing high to swing low. Hope you understand. Now, if the market was oversold and you are expecting that it's going to overbought in the 4 hour time frame or in the 1 hour time frame, remember you are coming from oversold. You are going to swing from swing low to swing high, since it has been oversold and you're expecting that it's going to be overbought. So you picture and put a large interval of pips. So the difference between scalping and swing low, swing high is that the risk reward ratio between the intervals are going to also be different. Remember, you are risking something high. It means that you're going to stand in the market for long. It may stand for 4 hours, it may stand for days. It depends. Hope you understand. That is for swing low, swing high trading strategy. When it has been overbought, look for trading opportunities in your prediction that is going to be oversold, and you place a trade. And uh, when it has been oversold, you look for trading opportunities that is going to be overbought, and you capture a peak from that particular interval. So you are staying in the market for long, capturing the market for long. How you understand? So the third type of forex trading is what I talk of day trading. So day trading is placing your trade during the day. You don't take over your trade at night. How you understand? You don't allow your trade to go over the night. Yeah, it goes over the night. You always make sure that the trade ends during the day, 24 hours. Or let me say, 12 hours. So it means that you can place your trade during the day from 7 a.m. At the beginning of the London session or at the ending of the Eastern session, and you can end at 5 p.m. when the American session or New York session or the American session is just ending. Don't bother. I'm going to upload a video that talks on the London session, American session, and the Eastern session in that video. These are confusing you. So that is it. The day trading, the simple aspect is that you stay in the market for long, but you don't allow your trade to peak overnight. It means that you're also going to stand in the market for long, and you're also going to picture a very large amount of risk reward ratio, the large scale of risk reward ratio. It means that you can use, for instance, it depends on your lot size. You can use 10 pips, you can use 10 pips, and risk reward ratio 1 to 3. Remember, 10 pips you have, for instance, You can use 10 pips, you have, for instance, 30 pips as reward ratio. But remember, it depends on your strategy. Other people can also use 5 pips. Other people use 50 pips. Other people use 100 pips. It depends on your trading strategy. I hope you understand. So what is it? What is here is that you stand in the market for long. Remember, it's all about during the day, and day traders at times they play with the daily time frame to place a trade. And remember, placing a trade in a very daily time frame, you must use a very large interval of risk reward ratio. I hope you understand. That's the case for, let me say, when I make talk of large reward ratio, I mean, for instance, 100 pips to 300 pips. That's a very large risk reward ratio. You can risk 100 pips to have to 300 pips depending on lot size and depending on your capital. I hope you understand. So the last forex trading strategy is what I talk of. Is what I talk of. Is what I talk of position trading. So with position trading, what you do here is that you are going to observe the overall direction of the market and look for trading opportunities in the overall direction. For instance, what many people do is that they can look for, they can capture the overall direction and they place a trade and stay for 2 weeks, 1 week, 2 weeks, 3 weeks, 1 month. I hope you understand. So it means that if you are entering this position, it means from the onset you are going to use a very large scale of risk reward ratio because you are selling the market for long. So you can place a trade and come and check the trade again after 1 month, or you can place a trade when again for 1 week. You can place a trade and come and check the trade after 1 week, or you come and check after 2 weeks, or after you come and check after 3 weeks, or you come and check that trade after 4 weeks. So you stand in the market for long. We call that position trading. And position trading always comes in place when you must have pictured the overall direction, the overall market direction. I hope you understand. So that is position trading. And remember, trading position trading is very, very difficult because it requires large capital. If you have large capital, the market can move against that direction. But if you have large capital, you can put a stop loss which is worth large. Since it's very worth large, it can resist the market. And since the market, since given that you are in the direction of the overall market, you are going to be profitable. You are going to be profitable because the market is going to move in your direction. But you know, forex is never predictable. You can be predicting, and the market is predicting against you. So make sure you follow your strategy. Make sure you follow your analysis. For this video, if this has been interesting, drop your comment in the comment section. Also, hit the subscribe button so that you will not miss our upcoming videos, and also I will link a link in the description and link in the description for our telegram community. But before that, in Facebook, I will do upload expensive signals there. You can check on Facebook, our Facebook page, Sambuin Forex. I'm going to drop our Telegram community link in the description so you can join as well and be profitable. I love you all. Stay tuned and continue to be profitable. Peace out.